Okay, so a very warm welcome to today's webinar. My name is Aaron Hill, the Chief Market Analyst here at FP Markets. Look, guys, I hope I am coming across loud and clear. I mean, I take it the audio is clear and the welcome slide is visible. As usual, any issues, please do fire me a message and I'll see if we can do something from this end. I just want to check. Okay, excellent. All right, so the objective of today's webinar is to unwrap the macro space and, as well as you can see here, ultimately translate data into decisions. Look, I'm happy to take any questions if they relate to the concept of the presentation, which should really take no longer than 40 minutes. But it is generally better, if you can, to wait till the end of the session, just in case I do answer the question throughout the presentation. I've spent a considerable amount of time thinking about the best and most efficient use of our time together. Ultimately, what I want to achieve from this is to leave you with a solid foundation to begin examining your trades from a different perspective, particularly if you do not incorporate macro into your decisions already. So the primary learning points, as you can see here, includes a brief understanding of a brief explanation of macroeconomics, deciphering the key economic indicators, and, as I've already said, translating data into decisions. And we'll then round off things with a live Q&A session. Questions missed, or those that deserve more of a detailed answer, please do feel free to email the research team at marketanalyst@fpmarkets.com. We'll throw that in the chat box. Also, please do feel free to send across any topics you wish us to cover in future webinars. Before moving on with the webinar, here's a brief disclaimer. So derivative products are highly leveraged. They carry a high level of risk and are not suitable for all investors. Look, I'm not going to bore you by reciting the entire disclaimer, but suffice it to say that the following presentation should not be considered investment advice. It should be treated as educational material only. So macroeconomics for me is really a fascinating subject, and when combined with technical analysis, it can really form a potent and an effective tool to navigate and trade the financial markets. Some of you may already know that I am primarily a technical analyst. That's what I've done for many years, for more than a decade now. But after incorporating the macro side into my trading, I found it really opened a door of opportunity, one that I feel that should be shared with many technical analysts, because I really do feel it adds an incredible edge to your trading. One that, once you learn, is quite amazing. To be clear, I am primarily an FX trader. Therefore, the majority of my attention is spent on drawn to this area. However, as you will be aware, the markets are interconnected, a web of correlations and inverse correlations that we have to be aware of. So macroeconomics, as I've already noted, it has essentially opened a door to a new, and in my opinion, a far better, a far more effective way of trading. Now, macroeconomics is essentially a lens in which we can look through, a lens with which we can look through at the economy as a whole. Essentially, what we look at is economic aggregates in the broader economy. So we look at the big picture to help answer things like whether the economy is growing, whether it's outperforming, whether it's contracting, what the jobs market is like, do we have stable prices, and whether we're in a recession. or an expansionary phase, and how interest rates affect us, and of course how decisions to consume or save. I just want to add that microeconomics and macroeconomics are interconnected, of course, with one another, but at the same time, they represent different approaches to studying the economy. So microeconomics looks more at the supply and demand of for a particular good, so cars or computers, for example. As I said, it's essentially individual markets, while macro looks, as I've said, at the bigger picture and assesses the economy as a whole. But overall, micro and macro are connected. I just want to put that out there because they are connected, as the collective decisions of the economic agents, you and me, form the economic landscape as a whole. So deciphering the key economic indicators. For me, there are three big economic indicators that we must all understand in order to trade. It's a bare minimum to trade from a macro standpoint, and that is GDP, inflation, and unemployment. Now, it's worth noting that GDP, inflation, and unemployment are all considered lagging indicators. So they tend to follow the changes in the economy. This is unlike leading indicators, which tend to change before the economy changes. So you can think of things like the stock market, new orders for manufacturing, those initial weekly jobless claims from the US, for example. They're all considered leading indicators. So for GDP, this is typically released with a delay, hence the hence it being a lagging indicator, and often undergoes quite revisions. This means that the reported GDP figures reflect past economic activity rather than the current or future trends. Now, as for inflation, so if inflation is high, it indicates that prices have already risen significantly or risen in the past, and the data doesn't necessarily reflect or tell us that prices will continue to rise or fall. So yeah, unemployment. Look, employers often adjust their hiring and firing decisions based on their outlook for the economy. That they may be slow to react to the initial signs of a downturn, for example, and similarly, they may be cautious about hiring employees when the economy starts to improve. So what is GDP? I won't go into too much detail here, but I just wanted to give you a brief understanding of the three key economic indicators. Now, GDP is one of look, I'm pretty sure we all know what GDP is, even if we're not interested in the economic side of things. GDP is one of, if not the most widely watched economic measure, and that focuses on economic activity. Now, the main objective, and this really sums it up well, I believe. The main objective of GDP is to provide us with a single value, a single dollar value that summarizes the dollar value of all the economic activity over a given period of time, which can be a quarter or a year. Now, it's an abbreviation for gross domestic product. So gross essentially means the total dollar value or the growth of economic activity for a country. Domestic means the goods and services produced within the border of that domestic country, the country's borders, and product means that the goods and services produced within that country. So it essentially forms us whether the US economy is performing or whether it's underperforming. Is the US producing more goods and services than a year ago, for example, or is it producing less output? If the economy is producing more, then it is it is generally good for the economy and its people, and will often lead to things like lower unemployment. This is why you'll see an inverse correlation between GDP and unemployment. So when GDP rises, you'll often see unemployment fall or decrease. Though a higher GDP can also cause higher inflation, which has been an issue for many countries in the past years, which I'm sure you're all aware of. On the other hand, a shrinking economy, so a shrinking GDP or a contraction in GDP, especially two consecutive quarters of contraction, can often signal a recession and is often accompanied by higher unemployment. I won't go into too much detail regarding the calculations, the calculation procedure for GDP, but suffice it to say, GDP is generally calculated in three different ways. That's the expenditure approach, the income approach, and the output approach. I find it easy to think of GDP as a circular flow model. Essentially, it's all about adding all of the spending, the consumption expenditure within the economy. So that's all of the spending from households to firms, and that gives you the one big number, and then you can see how much is produced within the economy. That's the dollar flow of the economy. You also have the income approach, which is where firms send factor payments, as you can see here, to households. That's the income approach. Look, I won't go into too much more detail regarding this. I just really wanted to put it out there. There are three ways of calculating this. And if you're interested, we do have articles. We do have a number of articles that the team have put together that go into much more detail regarding the calculation. But in theory, all three GDP calculation methods should yield the same result. But look, real world measurements, differences can cause slight variations between the three measures. Look, as you can imagine, it's a huge task for calculating GDP, especially economies such as the US, right? Hence why there are three estimates for a quarter. We have the advanced estimate, which is the first estimate that you'll receive. Then we have the preliminary, which is the second estimate for the quarter just gone. And then we have the final estimate. Now, as traders, the advance estimate generally garners the most attention, and you can see some serious moves, especially if there's a deviation from the median estimate, which I will go over very shortly. But yeah, so any questions, do fire away regarding that. Something else I just really wanted to get across to you guys is nominal GDP versus real GDP, because you will likely hear that once you start getting more into the macro side of things. So nominal GDP, I find it easier to think about it like this. GDP can rise for two reasons. One is either an increase in economic output, which is what we want, or an increase in prices, which is inflation. Nominal GDP factors in the inflationary impact and will therefore often be higher than real GDP. So if we think about it like this, if the price of bread doubles from one year to the next, but the quantity consumed or the quantity produced remains unchanged, nominal GDP would effectively double in price, but nothing new was consumed or produced. But if we use the real GDP, is the real economic output, what we do is we use base year prices. And this is what economists tend to focus on the most. And this is what you'll see from the US GDP. If you go onto the BEA's website, you'll see it's all real GDP. And as I said, this is economic outputs calculated based on base year prices. And it's essentially using prices from a year prior and thereby keeping prices stable and essentially focusing on what was produced or consumed to see if any economic growth was observed over that period. That could be a quarter or a year. All right, inflation. Inflation's a huge topic. Even now, it's in the media daily. I write about it almost daily now. Now, simply put, inflation is the rate at which the general level of prices for goods and services is rising, and consequently, the purchasing power of currency is falling. So you can feel inflation when you do your weekly grocery shops, for example, and um, this is just one common example. I think that's referred to as casual observation from an economist's point of view. Now, we measure inflation using price indexes. So we have the CPI, which is the Consumer Price Index, which is widely followed, which is just released today, and I will talk about that shortly. We also have the PPI, which, again, this is all related to the US economy largely, but we have the PPI, which is more of the wholesale inflation. This is what producers, the prices that producers pay. Then we have PCE inflation. Now, PCE inflation is not as talked about as the CPI measure. Look, the PCE data is incredibly important because this is one of the a lot of market pundits say it's the preferred measure. I don't know if it's the preferred measure of the Fed, but what the Fed do is they track just the headline PCE. It's not the core measure; it's the headline PCE number for their inflation targeting. So if you read back, I think it goes back to 2012. Inflation, they switched from, I can't remember what they switched from, but they switched from, I think it might have been CPI to PCE. So they focus on PCE, hence why it's so important. But for some reason, the financial news outlets tend to focus more on CPI, but PCE is incredibly important. That's your personal consumption expenditures index. Sorry for diverging a little bit there, but look, a slow rising inflation is often termed as a healthy or moderate inflation, and this is large. Central banks tend to target 2% for this, and this can be beneficial for the economy. Why? Because it encourages spending and investment from businesses, prevents deflation, which I'll go over shortly, and it can lead to increased economic activity, so an increase in your GDP. It also allows businesses to operate with a degree of reliability or predictability, whilst also providing workers with opportunities for wage increases. However, it's when you get high or unpredictable inflation readings that can erode savings, reduce purchasing power, and create economic instability. We saw that back with COVID, at the start of COVID, when inflation started to kick higher across. I mean, I'm sure you guys remember it globally. It was a global inflation issue. Now, inflation is often confused. So we have three types of main primary inflation ways of looking at inflation. So we have inflation, disinflation, and deflation. So inflation is prices increasing. This is what you would expect. So a price increase from one year to the next or a quarter to the next. And you have disinflation, which is confusingly prices increasing, but at a slower rate when compared to a previous quarter or a previous year. Now, deflation is when you see prices actually falling, so it's below zero. All right, so headline and core inflation. Headline, I've briefly, I have already spoke about this, and I should have really explained it when I did. I do apologize for that. But headline and core inflation are important concepts to understand, and you'll often hear market analysts and traders refer to this. So headline inflation includes all items. So if you look at the US-based version of CPI, they refer to it as the all items index, and it includes the more volatile components such as food and energy prices. And if you think about it, it is a better example of real world expenses. But then you have core inflation. Core inflation ignores or overlooks the food and energy prices, but it is by economists, it's thought to be more accurate and offers more of a stable indicator of inflationary trends. So what is the point of core inflation other than it offering a better view of stable trends? So imagine a country that is on the brink of conflict. So for instance, in the Middle East, this could affect the price of oil and potentially see oil prices rise in anticipation of a supply shock, right? So if a conflict in the Middle East does occur, this can really affect oil prices. So headline CPI inflation, which does include oil prices, would show higher inflation on the back of this. Core CPI would not. So a rise in oil prices would affect the headline CPI inflation, while core CPI would not show any effect to this because it does not include that. So just be aware when we're talking about the headline level, we're including all of those items, which is generally energy and food for the US. In the UK, I think it's energy, food, tobacco, and alcohol. So there are some differences among the countries, but it's pretty much, if you focus on food and energy, that's really the general exclusion for core inflation. Finally, jobs. Now, if I were to ask someone with no idea on the textbook definition of the jobless rate, what it means to be unemployed, they would likely respond that an unemployed person is essentially someone who has no job. And I understand why they would think that, but from an economist's point of view and the way it is calculated, it's to be unemployed is essentially the percentage of the labor force, which is the sum of employed and unemployed citizens within the economy that are currently jobless but seeking employment, but have sought employment in the last 4 weeks. So this is something to bear in mind if you're going to look more into the jobs market. As I've said, the unemployment rate is a lagging indicator, and it tends to rise for a few quarters after the economy has started to recover or improve. Remember, look, as GDP increases, which you will see in an economic expansion, the unemployment rate tends to fall. So when the unemployment rate is low and jobs are being added to the economy, it typically indicates economic growth, and vice versa for high unemployment. So a strong labor market generally boosts consumer confidence, right? And obviously boosts spending. So an uptick in consumption can drive businesses to invest more. It can also lead markets to expect higher corporate earnings, which can lead to higher stock prices. On the other hand, if we have a weak labor market, this can look, it's the mirror opposite. It can depress consumption and depress sentiment. It's also worth noting that if the labor market is tight, it can lead to rising inflation and thus future restrictive policy from the central banks. Look, I will get into the central bank very shortly. In fact, I think we kick things off in this slide. Guys, are there any questions so far? As I said, it's only a brief introduction to the macro side. Just remember, we have 3 key economic indicators, but really what we all want to do is translate data into decisions. So macroeconomic analysis is composed of really from a trader's perspective, is composed of 2 key elements. It's the central bank decisions and it's the economic indicators, 3 of which we've already looked at. It also includes something else. So we also have to include geopolitical events. So we can think of wars, for example, and tariffs. I write about tariffs on a daily basis now. So this all has to be factored into the equation. Now, to be clear here, I am going to discuss how I translate data into trading decisions. Other traders and investors may move differently, and that's fine. Let's be frank, we are all unique in our own ways of trading, and as long as how we navigate the financial markets results in a healthy bottom line, who really cares? Um, just to be aware that I won't trade the same as someone else, and vice versa. You won't trade the same as me. You'll find your own way based on the education that you receive and how you interpret market action. So first and foremost, I like to understand what the narratives are in the market. This is incredibly important and something that's often overlooked. So what you can see is traders they steamroll into the market, and they just look at the economic calendar, usually something like Forex Factory or something like that, which is quite limited if you're looking to take this seriously. They steamroll into the market and they think a better than expected print automatically translate into a higher currency. While it can mean that, it understanding the narrative can provide you with it can really influence how traders respond to an economic event. Now, what is a narrative of a market? So it's the current themes. It's nothing special. It's the current themes. So right now, of course, for me, we have two clear themes in the markets. We have Trump's tariffs. It's a clear theme. It's talked about daily, and if you'll be far-fetched to not have seen the effect of Trump's tariffs in the markets. We also have the Fed in the spotlight. So the Fed is an incredibly important organization to understand. So understand who the members are, understand who the hawks are, understand who the doves are, and you really need to understand what's going on with the Fed. And look, right now, so as I said, there's two themes. There's Trump's tariffs and there's the Fed. So the question of Fed Chair Powell. So Fed Chair Jerome Powell, his remaining time in office, which is set to conclude in May next year. So I'm sure you've heard across the news outlets, Trump is floating the idea of naming the next Fed chair, the shadow. So what you'll essentially have is potentially a shadow chair. Now, if you may or may not agree with me, but it's very, very unlikely that Trump is going to select a Fed chair that does not, shall we say, bode well with Trump's policy agenda, which is, if you just check his Truth Social platform right now, just scroll down a couple of posts and you'll see lower the Fed funds target rate by 3 points. So he's calling for lower rates. So it's very, very unlikely that he's going to place someone in the Fed chair's spot that doesn't agree with his policy agenda. Now, this opens up a whole can of worms in terms of the credibility of the Fed, in my opinion. So this is a big thing. So if or when he does name that Fed chair, and if he does follow a dovish, if he takes on so we've got Waller and Bowman, Fed members, Waller and Bowman, who have openly called for lower rates. So if he selects one of those, what do you think the market will do? It will sell dollars. US yields will fall because the anticipation of lower rates in the future. So what they're doing, essentially, traders there, they are trading into that risk event. So we have two themes. I have two themes I closely watch. Right now is tariffs, how that affects my trading decisions, and of course, Fed the Fed right now. Look, sorry for diverging somewhat on these, but yeah, these are the general themes for me right now. So with the narrative understood, we can then begin focusing. So we have the narrative, then we have the economic indicators. So we can begin focusing on what economic indicators we need to focus on, and then formulate a plan on how we are going to trade those data points. Now, there are two ways of, I'm familiar with two ways of trading risk events. So risk events means the economic data. So you can either trade out of a risk event, which means waiting for the economic data to be released, then acting based on that data. Or you can, as I've just briefly alluded to, you can trade into that risk event. which means you are trading based on the anticipation of a. So, for instance, if Trump nominates a dovish, a new selects a new Fed chair with a dovish who is likely to follow um, a dovish policy, you're likely going to see the dollar fall. And traders are trading into that particular event. Although it's a year away, you could see a downtrend on the back of that. Couple this with potential tariff implications as well. This could really add to the downside for the US dollar. So we have the narrative in play. Then we select what economic indicators to watch. So for me, it's inflation. Right now, inflation is a big thing. You can see that when Fed members speak. This leads me on to the next part. So we have central bank decisions are one of, if not the most important driver behind FX exchange movement in the FX market. So that's not just the actual rate decisions, but the expectations of future rate decisions. And alongside this, look, if you're serious about macro trading, you really need to understand that you need to follow all of those central bank speakers, because what they say is incredibly important. Understand who the doves are. Understand who the hawks are. Sorry, just hawks are. Understand what the central bank is signaling. So signaling is a tactic used by central banks to communicate its future policy intentions, to influence market expectations or behavior. So essentially what they're doing is they're saying what they want, and the market carries that out before taking any concrete policy actions. So central bank speeches, keep an eye on those. You should know who the the members of the central bank that you're tracking are, what they represent. Are they hawkish? Are they dovish? And things like that. So look, for example, let's imagine somewhat fictional example. Let's imagine the Bank of England. So let's imagine the Bank of England is tentative regarding easing policy, so rate cuts. Now, if we know that, but then we hear through the financial news that a key member or a key MPC member, a Monetary Policy Committee member from the Bank of England, is signaling that they feel that rates. So they're speaking to Bloomberg, for example, or live on Bloomberg, signaling that they feel rates should now be lower because of X, Y, and Z, when they previously supported a whole decision. Now, what do you think will happen to the pound and gilt yields? They're going to fall. All else being equal, you will likely see a decline in the pound, and that is quite an easy trade to take advantage of. So it's not just all about economic data, but that is something you can take advantage of if you follow the central bank speakers. Now, economic data, so GDP and inflation, for example, are also key drivers behind a large part of the currency markets movements. And this is what I track, and this is what a number of traders that I work closely with also track and trade and profit from. Look, this economic data is what central banks base their decisions on. And you may ask, what economic data do I focus on? So you can find this in the central bank's forward guidance. So every rate announcement is accompanied by a rate statement. If you look in that rate statement, you'll see what the central bank is focusing on. Now, if they're focusing on inflation and labor, the next couple of economic data points relating to either inflation or labor or jobs data will be incredibly important for the market. And you'll see this across all the terminals. They'll start speaking about this. They'll start forecasting. And so look, let me jump into the calendar. Let me see if I can switch the screens here. There we go. So this is the Refinitiv. I do hope you guys can see. Let me just check. So this is the Refinitiv economic calendar. Now it is quite expensive, but if you're serious about macro trading, I would wholly advise looking into this platform. You can get a watered down version of Refinitiv. I think it's Metastock, and it's very reasonably priced, but it is certainly something. The point is the data is released at lightning fast speed. I think it's just behind Bloomberg in terms of their releases. But yes, I've been very happy with it so far. Anyway, so when the news, I just want to, oh, I really want to get this across as well. So when the news hits the wires, so it, what price action is trying to do, what you'll see in the market, you'll see these, you'll see elevated volatility across those major asset classes. But what price is trying to do is trying to locate a new market equilibrium. And the narrative heading into, so the narrative, the market themes we just spoke about, can have a considerable effect on how much volatility is seen. It can mean the difference between a data point being ignored or a data point being widely traded. And it's also very important to understand that as traders, we don't focus on absolute levels. We focus on the change or delta of the data. So what do I mean by that? So for instance, here is the core, the CPI data that was released today at 1:30 UK time. We focus on the economists' estimate. So the Reuters poll here, we look at what economists have estimated. So this is the median estimate for the data. We look at that and then we compare that with the actual release. So for instance, core CPI for the US came in at 2.9% today, but it was estimated at 3%. So it undershot expectations, but it was higher than the previous data. So just remember that. The key thing that I like about the Refinitiv, these more advanced calendars, is they offer that maximum and minimum estimate. And this is something a lot of professional traders do focus on when they're trying to formulate ideas around those trades. So let's go for the headline figure, the CPI year-over-year US headline figure. We have the maximum estimate. This was 2.8%. So we have a distribution curve, and we have maximum 2.8%. And as you can see here, 2.4% at the lower end, and the median estimate was 2.7%. So can you imagine if we get a print, so a print of 2.9%? What does that tell you? That tells you that we've completely surpassed all economists' estimates. And this can really drive, especially when you get a broad release of actual data that surpasses those economic estimates, those maximum or minimum estimates. So again, very important. Focus on the actual data and the economists' data. Okay, so this will be, so for instance, on Forex Factory, you'll only have access to the median estimate. That's the middle point of your data. But on the more advanced calendars, look, I think there are some good calendars out there now that do show this. I would do your homework. If you can't afford one of these more expensive calendars, do your homework, have a look. There are some good calendars out there now that really do offer a lot. But yeah, so the maximum and minimum estimate is incredibly important for me as a trader. What's important to understand is that the economic indicators, they create a short-term bias in the market. So they are certainly something we can trade and you can make money from. And what you're looking for is the economic indicators to align with the longer term bias. And the longer term bias is derived from those central banks. What are they looking for? Are they looking to raise rates? Are they looking to lower rates? Are they on hold? I mean, look across the curve right now. We have central banks all cautious. Some are lowering rates. I think we had the RBA. No, the RBA surprised. Excuse me. The RBA surprised. I think it held. I look at some of these central banks now, and I get confused sometimes. But yes, so you're looking at what the central banks are doing. Are they looking to raise rates? Are they looking to lower rates? Are they on hold? Are they cautious? What are they looking at? What economic indicators are they looking at? What are the majority of the members looking at? I mean, take the Fed, for example. The Fed's last meeting, the 17th to the 18th of June meeting, and the subsequent minutes from that meeting, what did it show? It showed there is division among committee members. essentially, inflation is at the forefront of the Fed right now, hence why there was so much media attention around the CPI release today. Why is there so much attention? Because on one side of the Fed's camp, we have Fed members looking almost downplaying the inflationary impacts of Trump's tariffs, thinking it'll only be a one-time price increase. And it could be, dare I say, the T word, transitory. But on the other side, we have a more cautious camp who are a little more concerned about the longer term implications of rising inflation. And obviously, those are more open to keeping rates at more elevated levels, while those who think it's just a one-time spike want to lower rates, which is something President Donald Trump is repeatedly calling for. I'm sure you've seen the insults he's thrown at Powell recently. I won't voice them here, but just search on his feed and you'll see he's not holding back. Let's put it that way. So if you're anything like me, this sounds great. When I first started learning about macroeconomic analysis, I'm thinking, yeah, this really makes sense now. But how do I use it? How can I put this? How can I formulate these ideas into my head? How much time do I need to put into this? How much more do I need to study for economics? Do I need to study for a degree? Let me just be clear, you do not need an economics degree. Some of the best traders I know who trade with macro, who combine macro and technical analysis in the FX space, do not have an economics degree. They do not have any financial degrees, but they are amazing at how they can interpret the data and they trade based on that. It will take time to understand, it will take time to learn, but the best things in life do, right? If you can learn how to interpret macro data and you have a good, solid understanding of technicals, you can really generate some good trading ideas. So let's take a look at something, as you can see on the screen, something that should help solidify this this process. So there's a keen focus on inflation right now as Trump embarks on his trade policy. I'm sure you've seen all the news, the headlines of Trump's tariff threats and things like that. I mean, the market has become a bit numb to it now, but it wasn't in the beginning. It was just complete chaos. So for anyone that doesn't understand, a tariff is essentially a cost to US businesses. So that so the business has to pay an additional, say a tax to import foreign goods. And these additional costs could, I emphasize the word could, be passed down to consumers in the form of price rises, which means potential inflation down the road. Now, a lot of economists that I've spoke to, a lot of traders that I've spoke to are not expecting much to show up in the June data. As you can see, we did get price rises, but nothing to get really excited about. But they are looking at subsequent months for potential inflationary impacts, and they do expect inflation to rise. So what did we know? Heading into the US CPI data, what did we know? Well, we knew that May inflation across all of those key measures, CPI, PPI, and PCE data, all saw moderate upticks in inflation. We also knew what economists were estimating. So we knew headline, they were expecting 2.6%. We knew on the core level, this is year over year, we knew on the core level, they were expecting 3%. So they were already expecting an uptick in inflation. We knew the prior data was 2.8% on the core. We knew the prior data was 2.4% on the headline. What we essentially, so there was a lot riding on the June US inflation report, but it was quite tricky to trade in my opinion. What we essentially saw here was US headline inflation surpass the market's median estimate, but fail to reach surpass or even reach that upper estimate range of 2.8%. So yes, we have seen inflation increase, and it beat expectations, but it failed to really breach that upper estimate range and really create that wow factor, if you will. So it really didn't raise too many eyebrows in that sense. Now, if we got 2.9% or 3% at the headline level, then we're looking at some serious dollar moves, and that would have sent the dollar screaming to the upside, I believe. If We also saw core inflation not undershoot the median estimate here of 3%. If we'd have seen the core measure also come in at, say, 3.1%, this is the maximum estimate here, or 3.2%, the move would have been quite something. And this is where you can make money, is when you get those broad measures coming in line with, and it makes total sense to trade the dollar long. Because look, you also have to take positioning in. I haven't gone into this because I thought it might be a bit too much for any beginners watching, but do also look at the positioning data. So this is the futures data for the commitment of traders report. What you can get from that, although it is somewhat lagging, you can get how traders are positioned. Large speculators are positioned. Right now, the dollar is overstretched to the downside. So can you imagine if we'd have got a much higher than expected US CPI inflation print? This would have seen traders unwind, a lot of them traders unwind those short positions to take advantage of this. So that have squared off their short positions, and this would have added to that upside. So it would have been a huge move to the upside. And this is something I was actively looking for, but as you can see, we didn't get that. It was a tough one to trade, I felt, and you could see that in the market, the immediate market reaction. We saw the dollar and treasury yields fall. US equity index futures, because the cash market wasn't open at the time, did also pop higher, but then it quickly paired its move. So I hope I've not confused here. I'm now going to open the floor to any questions, because that's really all I have. I hope what I've done is opened your eyes to a different side of trading when you compare. So, for instance, let me just add to this: if the dollar did come in, if the US CPI inflation did come in higher than expected across all those key measures there, and we had a dollar. The dollar started exploding to the upside. Now, how do traders trade out of that risk event? Some would essentially throw in a long position. But the problem with that is, I found, is the slippage. I'm sure you've seen, right? The slippage increases dramatically after a news event, especially something like this, increases dramatically, sometimes 40 pips. But they still trade because they know the move is potentially going to extend a lot further than that. So you can enter a long position on the basis of what we've just been speaking about, and set your stop using an ATR or something like that. It's the average true range. Or, like me, I'm more of a cautious trader. What I like to do is I like to wait for the data to come out, assess it, it's about 5 minutes. Sometimes it's between 2 to 5 minutes. I assess the data, and I have my technical levels ready. And as you said, as I already noted, I am primarily a technical trader, so I believe I'm well versed in key support levels on the short term and the long term. So I'm aware of where those big levels are on the longer term and on the short term. So what I look for is, for instance, if the dollar rushes to the upside on the basis of a beat in the data, I look for that to break a key support level, be it on the short term, be it on the long term. I look for it to break that key short term level. For anyone that's followed me years ago, you may remember I was a big fan of those Quasimodo levels. Just do a search, Quasimodo FP markets, you'll see them come up. I'm still a big fan of them, and that is one of my key levels I look at. So I look for a break of a key level, and then I look for a retest. You'll see it. It's quite amazing. You'll see it break the level, come back, quickly test that level, and give you a lovely little entry with good risk to reward, where you can scalp into the position and get out at a profit. I find that a lot easier. It's just my personal preference. I really don't like entering based on an immediate data release. So I like to wait for things not to settle down, because I'm looking to take advantage of that volatility, but I'm looking for the immediate move to play out, and I'm looking for a close above that level. So once that's closed above that resistance, in this case, I look for a retest of that support. I'm not looking for any candle confirmation or anything like that. I'm looking for a retest. Once we've closed above that, say on the 5 minute or the 3 minute time frame, or even the 1 minute time frame, I look for a close above that, and I look for a retest of that support. Then I'm in, and I look for the surrounding support level to place my stop. Nothing more, nothing less. There's nothing complex about that. It's just knowing the right levels. So IQMs, the Quasimodo levels are a big, big thing for my technical approach, and I have all them plotted out beforehand. So yes. Ooh, any questions, guys? I do hope I haven't confused. I'm just going to check if there's any Q&A. Bear with me. When we're going to to answer your question, when we're going to see charts? I don't have any charts for you. This is mainly about macroeconomic analysis and not about technical analysis. So yes, I hope that answers your question. It's just basically the purpose of this webinar is not about chart trading per se. It's about understanding why the markets are moving. Once you understand why the markets are likely to move, then you can look at when to enter. And that is where your technical analysis comes into play. Just going to check if there's any other questions. Guys, you're very quiet. I mean, do step up. If you've got any questions, please do ask. Look, let me just get the dollar index up quickly. So the dollar index, so as you can see here, I mean, the dollar index has really started to, so let me go down to the 5-minute chart just really quickly. So this was a reaction to the, you can see what I mean by the reaction to the US CPI. So we had an immediate move to the downside and then to the upside. So if we had a beat on the data, I would be looking for price to, say, break above here. This is just imagine that's key, and then retest that level, not hold, not do anything else, and then look to take a long off of that level. Do they always hold? Of course they don't. Anyone that tells you that they trade with 100% accuracy is, quite frankly, lying. I've never met any trader that trades with 100% accuracy. I have met traders that do trade with considerably high win-loss ratios and do very, very well. And you'll find that the majority of these traders do trade with macro or some basis of economic analysis. I'm just reading the question there, Mike. Sorry, guys. Yeah. So thanks for your question, Mike. Look, there just to answer, there will be a recording available. Sorry, I should have mentioned that there will be a recording available. It will be live on YouTube very shortly. In terms of a calendar at an affordable price, I'm trying to think of the name. Sorry, I'm trying to think of the name. There are a couple of calendars, but Trading Economics is a very good one. Trading Economics. I don't think it offers the maximum or minimum estimate, which is a shame. But if you do some research, I'm pretty sure you can find this at an affordable price. But yes, I can wholeheartedly recommend the macro trading is the way to go. I feel it is. But it has... The problem with it right now is, although you can still find good opportunities, Trump has muddied the waters somewhat. So with his... how can you trade Trump? For anyone that knows, let me know. How can you trade with that guy in the background? One tweet can move them. Sorry, not one tweet. One post on his Truth Social platform can move the markets and can ruin a perfectly good trade. You'll also find that recently the reactions that would have been good reactions to trade have not been as volatile as they would have been because everyone in the market is cautious right now. They're just not sure what Trump is going to do. That one man has caused all of this uncertainty, not only with the central banks, but also with market participants as well. So yes, the first thing to do is get a good calendar at an affordable price. I agree. One that offers you that maximum and minimum estimate. I'm pretty sure if you do the research, there are calendars around that do that. I haven't really done the research for that because I have access to Refinitiv, but yes. So I hope that's answered your question there, Mike. Aaron, yeah, same with me. I was mostly into. I still am mostly into technicals. That's where my career started. I did the CMT course. I'm not sure if you've heard of that. The CMT, the Chartered Market Technicians course. It's quite in depth. If you're interested in technical analysis, I would wholeheartedly recommend that. But honestly, Aaron, I would really look into this macro side of things because it can really, the thing is, technicals aren't answer the question of when to enter the market, right? It gives you that support. As you can see on the chart, you have the resistance. You know what you're going into. Most people know multi-time frame analysis, the monthly time frame, the daily time frame. But we all know where we are. It's I wouldn't say it's easy to learn. It's easy to learn the basics of technicals, but it's hard to get very good at this, I believe, and get a feel for the markets. But when you incorporate macroeconomic analysis into this, and it really isn't that hard to learn, you only have to pick a couple of a couple of central banks to follow, and those key macro statistics. You don't have to be an economist. Just put some effort into learning about this, and it can really open a door to a new and pretty exciting way of trading. As I said, I'm not one for jumping in the market straight after the macro event or the risk event. They call them risk events because they are event risk is released. I'm not one for that. I don't like the slippage. I don't like that risk. I like to wait and see how the market reacts to that um, print. I hope that answers your question. Well, a question, Aaron. I hope that addresses what you said. Mike, do you have other videos on your YouTube channel? We do. We've only recently just started doing these webinars. This is the first one in a long time. We've just reignited the trading channel, but we have another one coming up at the end of this month, which I will focus on geopolitics. But look, this is something I feel that traders do want to learn more about, and I do understand why. So if there's demand for it, we will go into more detail. I will trade live events with you guys, and we'll go into much more detail of how I look at things. Look, like many things in trading, right? It's not meant to be exciting. It's meant to be boring. Good traders, they trade in a boring fashion, right? We've seen all the videos, right, where they're screaming and shouting. Good traders are calculated, are meticulous in how they trade. So, as I said, I look to trade the most high probability trading opportunities I can possibly find. And that means when the central bank is aligned, when the economic data is aligned with that central bank, and I have a good technical setup, that is where I pull the trigger. And just look into it more, and I'm pretty sure you'll be surprised at the results you can find. That you'll find if you put a lot of effort into learning. As I said, you don't need to learn. You don't need to study take an economics degree, but you do need to really focus on macroeconomics. Now, look, in terms of macroeconomics, two good books I can. If you guys want to learn more, there's two good books I would wholeheartedly recommend, and this is what really I was recommended this by a macro trader that, like I'm doing with you guys right now, I'm trying to get technical analysts focused more on the macro side. Two books by Brett Donnelly. I think I have one in the background here. Yes, Alpha Trader in the background. Brett Donnelly, Alpha Trader, and I have it here. There he goes. So here we go. This book, The Art of Currency Trading by Brett Donnelly. A fantastic book. Fantastic book. I cannot recommend this enough. It's about £30, £30, $40, I guess, wherever you're based in the world. But have a read of that book. He's very good at writing. He makes it very clear on how to trade, and he will. It really goes into more detail about what I've said here, and it should put you onto the right track. But yes, Brett Donnelly, The Art of Currency Trading, and the Alpha Trader. Again, Brett Donnelly. Brilliant books. All right, guys. Any other questions? Just check. Okay, I don't think there's any more. All right, so guys, thank you very much for taking the time. Look, I hope I have provided you with. You're very welcome, Mike. I hope I've provided you a foundation, like a foot into the market, if you will, into this type of trading. Again, look at those books I just recommended. It will open your eyes to a different way of trading. If there are any questions, please do. Please do forward them to marketanalyst@fpmarkets.com. Also, check out our social media channels. I'm active on the social media channels every day. We also release a First Light News market briefing in the morning, which addresses what's happened overnight and what to expect. But yeah, so thank you very much for joining, guys, and I'll catch you all in the next webinar. Thank you, guys.